Dividend discount models, DDMs, are valuation models used to estimate the intrinsic value of equity securities based on the present value of expected future dividends. The program explains that the fundamental principle underlying DDMs is that the value of a stock equals the discounted value of all future cash flows that shareholders expect to receive. Because dividends represent direct cash returns to equity investors, DDMs provide a theoretically sound framework for valuing companies that pay regular and predictable dividends. Analysts use these models to estimate fair value, evaluate investment opportunities, and compare intrinsic value with market price when making investment recommendations and portfolio management decisions. The basic dividend discount model values a stock by discounting expected future dividends using the investor's required rate of return. The general relationship is expressed as follows: V_0 equals \sum_ t equals 1 caret \, empty \frac d in open parenthesis 1 plus r close parenthesis to the power of t, where V_0 represents the current stock value, d_t represents expected dividends, and r represents the required rate of return. The program emphasizes that the model assumes investors purchase stocks primarily for future dividend income and capital appreciation driven by dividend growth. Because forecasting dividends over an infinite horizon is complex, analysts often apply simplified versions of the model under specific growth assumptions to improve practical usability and forecasting efficiency. The Gordon growth model, also known as the constant growth DDM, is the most widely used simplified dividend discount model. It assumes dividends grow at a constant rate indefinitely and is represented by the following equation: V_0 equals \frac d_1 rg, where d_1 is the expected dividend next period, r is the required return, and g is the constant dividend growth rate. The program explains that this model is most appropriate for mature companies with stable earnings, predictable dividend policies, and sustainable long-term growth rates. Small changes in the required return or growth assumptions can significantly affect estimated value, making careful assumption selection essential for reliable valuation results. Multi-stage dividend discount models are used when companies experience changing growth patterns over time. Many firms initially grow rapidly before eventually transitioning to stable long-term growth rates. Multi-stage models divide valuation into different phases, such as high-growth periods followed by stable growth periods. Analysts forecast dividends separately for each stage and discount them back to present value. The program emphasizes that multi-stage models are more flexible and realistic than constant growth models for valuing growth-oriented companies. However, they also require more assumptions regarding future growth, profitability, and payout policy, increasing the complexity and uncertainty associated with valuation estimates and forecasting accuracy. The required rate of return plays a critical role in dividend discount valuation because it reflects the risk associated with the investment. Analysts often estimate the required return using models such as the Capital Asset Pricing Model, CAPM, which incorporates risk-free rates, market risk premiums, and company-specific systematic risk. Higher required returns reduce present values because future dividends are discounted more heavily. The program notes that DDM valuation is highly sensitive to assumptions regarding both growth and required return. Companies with unstable dividend policies, uncertain growth prospects, or limited dividend payments may be difficult to value accurately using dividend discount methods alone, requiring analysts to consider alternative valuation approaches. Dividend discount models are valuable because they connect stock valuation directly to fundamental cash flow expectations and long-term shareholder returns. They are particularly useful for mature dividend-paying companies such as utilities, consumer staples firms, and financial institutions. However, DDMs also have limitations, including sensitivity to assumptions and reduced applicability for companies that do not pay dividends or have unpredictable payout policies. The program emphasizes that analysts should combine dividend discount analysis with broader financial statement evaluation, industry research, and alternative valuation methods to improve reliability. A strong understanding of DDMs enables analysts to estimate intrinsic value more effectively and make more informed investment and portfolio management decisions within equity markets.